on a topic that is very close to my heart, because I have been working extensively on it, and I will be more than happy to share my knowledge with the participants on the same. Uh, so, Starting with the topic on internal financial controls, I would like to start with uh, the understanding that it is an extension of audit, which is our identity as a fraternity. So, when we speak about audit, we are all auditors first, more than anything else that we may identify us as service providers. And with that, if we look at the history of audit and the auditors, the basic principle has been same for hundreds of years, right from Chanakya Niti. It is trusted but verified. We would not trust on anything blindly, and on verbal communication. So, as auditors, this is our profession, and IFC is just an extension of the audit, which the entities are required now to have in place, more specifically in terms of processes broken up into individual controls and the risks underlying those controls. And this framework, once documented, the entities need to have their comments and review on it on a year-on-year basis, which needs to be further documented and commented on by various stakeholders. So with this, I'll start my screen share and take a little deeper understanding on the same. So internal financial controls. I would like to first put across a complete framework under which the internal financial controls are covered. So this comes under corporate governance, the Companies Act 2013, and CARO requirements 2015. Now there are various stakeholders which need to give their comment on it, which would include the director's report, the audit committee, independent directors, and so forth. So going further into detail, on introduction on IFC. So IFC was not a requirement unless and was introduced as a requirement by the Companies Act in 2013. Before that, while the provisions were, the framework was used as COSO framework under by various entities for their own testing procedures, but it was not a requirement under the statutory requirement list. 2013, the Companies Act introduced a Session 134, which required the companies to have a framework and the stakeholders to comment on the operative effectiveness and the design effectiveness of the controls on a year-on-year basis, which further will be commented on by the auditors in their report, by the audit committee before presenting their report to the board, and by the independent directors by satisfying themselves that whether the controls are efficiently operative under the current framework of the organization. So internal financial controls are in are split into three different areas. One is internal control over financial impact. So this will include the processes and the controls which have an impact on the financial reporting. So this is also called as ICOFR, which is internal control over financial reporting. when we add the operational controls such as my production controls, whether my bomb is adequately uh, defined in the system, whether it is tampered or such other controls which are hardcore operational controls, and whether my fraud prevention reporting framework is in place, all put together forms my internal financial controls. So again, depending on the entity requirements, some entities have a requirement of only reporting on the ICO framework, and some companies have internal financial control reporting requirements. This will also help us have the complete review of efficiency and effectiveness in operations, prevention and detection of fraud and error at an early stage, safeguarding of assets, accuracy and completeness of accounting records, and reliability on the financial reporting. The last point, reliability on financial reporting, is of crucial importance here, because the entire framework focuses on whether there are controls in place to ensure that things cannot go wrong, and whether those controls are effective. So the entire focus is on reliability of financial reporting. Let us talk about some common myths of IFC that we have come across. Now, when we talk about IFC, usually the perception is that if I have a policy in place, then I do not need a risk control matrix framework or the ICOFR framework. Or if my controls are in place, then there is no need to revisit them or document the testing, which is not true, because a lot of times either my controls become redundant, or there are change of hands, or there could be n number of uh, other reasons why a particular process which was defined and put in documented in place but is not being followed, or is not being followed with the requirement of the purpose of the control. So say for example, if I have a control which says a BRS should be prepared at the end of every month, but if the BRS is being prepared and there are reconciling items with errors in it, and if it is not reviewed and rectified in timely manner, the purpose of the control fails, and thus there will be a negative marking in my testing remarks. So similarly, these controls need to be first designed and put in a framework, and simultaneously uh, should also require revisiting them and testing the operational effectiveness of these controls on a time to time manner. So if there are changes in policies, or the documented policy is X and there is a change over a period of time on this documented policy, it needs to be somewhere mapped in the framework. And when we test it on a regular interval basis, it gets identified then and there. So there are three major aspects of internal financial controls as we speak. One is companies having policies is required, but having them reviewed on an interval basis, on a regular periodic interval basis, is important to understand the effectiveness. So having a control is one of the requirements, but having that control which is operating and effectively operating over a period of time is more important in this framework. So year on year, the management is first required to review their own books of accounts and give their comments on their satisfaction whether the framework is in place, adequate framework is in place, and whether the framework is operating effectively during the audit period. And these remarks are then reviewed by auditors with their own testing performed by them, the stat auditors, and they need to comment whether they are satisfied with the testing remarks and the operative effectiveness of the entire framework at the end of the year in their report. One of the other myths is also that there is no need to provide training and development to the employees. This is a continuous need in any organization that you would visit, because uh, there are usually a lot of attrition happens in an organization, and with attrition or with change in hands over a period of time, a lot of processes that were being followed by the first person may or may not be followed by the following person. So with these attrition issues and change in hands, the training and development of employees becomes even more important to ensure that the entire framework of the company is implemented and relevant for the audit period. Moving on, applicability of internal financial controls. Now, when we talk about applicability of internal financial controls, uh, both public listed companies, unlisted companies, and private limited companies, and under certain categories are required to report their compliance with the IFC requirements, and the different stakeholders with the respective companies are required to comment on whether this framework is effectively and designed properly and operating effectively during the year. Now, what are the areas where the IFC is applicable? So this is an illustrative list again: human resources and payroll, inventory management, logistics distribution, capital expenditure, information and technology, finance and accounts. This would also include processes such as my procure to pay, my order to cash, etc., etc. So when all these all the critical processes which are required to be maintained and policies are drafted in an organization, would also require to have a risk control matrix, which I'll be sharing the template going forward, under which it has to be identified under the major process, and it is further broken up into smaller processes. Now, let us come to the section where we talk about who are the stakeholders and what are their requirements that need to be uh, complied by them under the Act. So, Section 134 refers to director's responsibility of the statement. And in case of listed companies, the director's responsibility states that directors have laid down IFC to be followed by the company, and that such controls are adequately and operating effectively. So, both the controls are adequately designed and operating effectively. Now, when we talk about effective operations and adequate designing, we'll be talking about it a little in detail going forward. But the directors first need to make sure that this framework is available for the company and the company to follow, and is adequate and effective during the audit period. Then comes auditor's report. When we talk about auditor's report, the auditor's report should also state whether the company has adequate IFC system in place and operating. So one is the director's responsibility statement, which essentially means the management of the organization first needs to put this in place and test it for themselves, so that they can provide a satisfactory framework testing documentation to the auditor for their review. Now, while the management is itself required to get this framework prepared and validated for themselves, the auditors need to do an independent review of the controls and satisfy themselves whether the reporting of the directors is actually adequate or not. So whether the management remarks where they say that a particular control is satisfactorily and effectively operating during the audit period, auditors may need to look at the effectiveness and adequate designing and satisfy themselves through their own samples and testing procedures. uh, uh, this is a separate activity that the stat auditors themselves need to do. Then comes section 177, under which the audit committee needs to call for comments of auditors. So here, the audit committee of an organization needs to call for comments of auditors about about their satisfaction on the internal control systems before they submit the management report to the board, and they may also discuss any related issues with the internal and statutory auditors and the management of the company. So the internal and statutory auditors and the management of the company need to be on the same page before the audit committee goes to the board. So there is a proper audit committee meeting that takes the report from the management, takes a concurrence of the same from the stat auditors, and is aligned before the board presentation happens for a particular company. Now, independent directors. So even the independent directors on the board of a particular organization need to satisfy themselves of the risk management system, whether it is robust and defensible. So when we talk about independent directors, we need to understand. We need to understand that independent directors will get their satisfaction from the reports of the auditors and management, and they need to get clarifications wherever required and satisfy themselves on the integrity of the financial information which is being presented to the board for approval of the financial statements, and ensure that the financial controls and systems of risk management are robust and defensible. So these are the major stakeholders these are the major stakeholders for the IFC related framework. Now, the company management, it could be either ways. It could take assistance from a professional firm. It could have its own defined team, which does the IFC testing for the audit period. But they need to certify effectiveness of the internal control systems pertaining to financial reporting. Along with this, year-on-year basis, during their assessment, if they find that there is a requirement to update the controls, or there's a change in process, or with the IT environments rapidly changing, if there is a shift of manual controls to automated controls, this updation to IFC and the risk control matrix need to happen on a year-on-year basis. This is one of the responsibilities of the company management. Then auditors state their report whether the company has adequate internal financial control. So, say for example, if one of critical processes has been missed out by the management, or whether if there are any new compliances. For example, audit trail is a new compliance that has come into place for the current year. So it could be possible that we have audit trail requirements which is being applicable from current year, and the risk control matrix doesn't talk about any control to ascertain that the company is compliant with the audit trail requirements. So that will be a specific update to the risk control matrix in the current year. The next point is effectiveness. So again, when we talk about effectiveness, we've been talking about effectiveness at various intervals. When we talk about effectiveness, we talk about two things. One is whether, so if the control says that bank reconciliation statement is prepared on a monthly basis, whether it is actually being prepared on a monthly basis, or so we if it is a monthly control, again there is a institute guideline which has been issued, I think somewhere in 2014 or 15, which has given a guideline on what is the kind of sample we need to select to verify whether the control is effective. So it has defined, for example, if it is a quarterly, the frequency is quarterly, then it will be on a uh, you will have to verify at least 2 quarters during the audit period, that is the current financial year. If it is a monthly control, then there will be a requirement to review at least 3 to 4 months for which the control has been complied with. Again, these are sample months which are selected by the testing team, and the documentation is verified as against the uh, entire control and process-wise control matrix that is that is prepared. So the samples are again selected on the basis of the risk rating of the control. There is a defined matrix that has been given under the guidance note. Now, when we talk about the audit committee, the audit committee, one, as we discussed, calls for the comment from the auditors. And if there are any observations or failures reported by the stat auditors, they would call for further details to understand what is the reason for the failure, whether it is critical or if it is a medium or a low risk kind of a control. And then this entire report is submitted to the board of directors. Now, the director's responsibility statement has to give their comments on effective operations, which has to be in line with the auditors and management comments of the testing of the year. And a board of directors report needs to state the details in respect of adequacy. So they need to comment on what is the framework that they have in place, and whether it is adequate as per the size of the organization and the turnover. So it has a materiality concept and a definition underlying it. Now we will let us look into the approach that is taken for understanding the testing and objectives of the IFC. The internal controls, the objectives of internal control testing should provide is that it should provide reasonable assurance to achieve uh, reliability of financial reporting, compliance with applicable laws and regulations. So all the compliance, statutory compliances that a particular organization falls into, whether the organization is compliant with those requirements. So there has to be a uh, uh, the objective of this entire framework is that nothing is being missed out of the gamut of the compliance requirements under which a particular organization falls. And of course, effectiveness and operation efficiency of operations, including fixed asset. So fixed asset is also one of the processes for which a entire risk control matrix will be required. The next is internal controls need to be evaluated. So when we talk about evaluation of internal controls, there are two broad levels at which the internal controls must be evaluated. One is entity level, which is irrespective of which process the control falls under, it should be applicable to every person being a part of the entity. So these controls are called entity level controls. For example, if I have to share an example of one such case, it would be something like sexual harassment policy. This, irrespective of whether I'm a part of my finance department or operations department or HR department, will be applicable to each and every individual in the company, right from uh, uh, right from an office boy to a director. It is equally applicable to every individual in the organization. So such controls will form a part under the entity level controls and my process level controls, which of course means that once I look at the individual processes, say for example, a purchase, procurement to pay process or a order to cash process, if I have to take balance confirmations from my daters. So that falls under my order to cash process, and whether I'm doing it on a regular interval as defined by the company. So this is majorly into evaluation. So there are multiple risk control matrix that need to be prepared by the company, which covers all the major processes the company is looking under. Other than this is the components of internal controls, which can be mapped to major five broad heads. The components would include control environment, risk assessments, control activities, information and communications, and monitoring. Now we will talk about these in detail in the following slides. But when we talk about control environment, it essentially forms a part of which type of control environment. So it could be a entity level control, it could be a IT related control, it could be a particular process related control. So that is what a control environment means. Now, a roadmap of implementation of IFC. Now, when we talk about a roadmap of implementation, this is a step-by-step process, and it is a cumbersome process because the organization has to put across a risk control matrix for the entire organization, making sure that all my major processes and activities are covered under the said risk control matrix. So on an average, if we look at a fully functional organization, there would be an average of 8 to 9 risk control matrices, which will require to be documented, categorizing each major process and then breaking it into further sub processes. So the first step to this implementation comes to assess the current state of internal audit. So internal control. So first is understanding the as is process, and while what might look as a procedure would have an underlying control under it. So identifying the controls under a particular procedure and understanding the as a state, whether it is adequate or there are any gaps or any additional controls that need to be put in place. Embrace the widely acceptable framework or guideline. So taking base, frameworks like COSO framework or the guidelines that are issued by ICAI, and understanding what is an ideal procedure or ideal controls that need to be in place for an organization. As against that, set the right tone. So again, all these activities, all of us are aware that majorly depends on how serious the management and the organization itself is in making it useful and operating effectively, because the organization and the process owners would usually be very reluctant on adding a particular control, which might for them feel like it is slowing down their current pace of operations, etc. But these small controls are safeguarding the organization from larger mishaps, like maybe a fraud or an unidentified error in time, which might result into fiasco at a later point in time. So the management or the top level process owners of the entities need to be very determined to put across the frameworks and make sure that it is operating as per the framework to make this entire exercise a success. So identifying the organizational risks which may have an impact on financial reporting or have a financial impact on the organization, and then defining control objectives and control activities to mitigate those risks. So the entire framework talks about identifying processes, one, from those processes, ascertaining whether there are any risks underlying these processes, and then mapping the controls with their objectives. So, if there is a risk of something going wrong, what is the control objective? Is making sure that it is not possible that this might fail, or this might not go identified. For example, the simplest example would be approvals. So, for example, for issuing any PO approval, you might need to submit price comparisons. So, this is as simple as if I have a system approval of PO in the system itself, then it is a system controlled environment where my system will not allow me to issue a PO to a vendor without having adequate approvals under it. And on continuous basis, so one is defining the entire risk, underlying controls, processes, and the control activities to mitigate the risk, and ongoing continuous monitoring. So once it is identified that these are the risks and these are the controls, whether it has actually been monitored, and somebody has gone and checked whether as per the control the activities are actually happening. So something as simple as that, I would have understood that this will be controlled by the system, say PO approvals. But if after the approval I'm able to go and amend the PO, then that is a failure of the control, because my approval is only a pass-through requirement. And if I'm able to change the PO after the approval, then I will be able to do or issue a PO as I want to, without any specific approvals. And the last part is obtain independent assurance on effectiveness. So sometimes having the same team who is operating on the controls and validating that yes, they are complying with the controls may not be as effective as a third party perspective who would look at it from a bird's eye view. So this is a step-by-step roadmap of implementation of IFC. Now, when we talk about risk control matrix, it depends on two factors. One is the likelihood of a particular error happening without any specific attention towards the particular control, and the impact of that error. So the higher the impact, or the higher the probability, the higher the risk is. Now, when we talk about risk, we also talk about controls simultaneously. Controls could be operational controls, financial controls. Now, operational controls are, more like physical counting and checking of material goods received at a warehouse. So all these kind of controls form a part of my operational control category. Now when we talk about financial controls, it majorly depends on my payment controls, whether my expenses might take a hit without adequate approvals, whether I have done adequate comparison of prices before making a major purchase from the from a third party vendor, etc. Now the control is defined under multiple this thing categories. So whether a control is a key control or a non-key control. So a key control would essentially mean something which is important and the impact of which is high for the organization. So say for example, if I have a plant which has a 5 crore fixed asset placed at the plant, with multiple plant and machinery implemented at a particular plant, and if I miss out on taking insurance of the fixed assets there, and there is a fire breakout, my impact will be very, very high, because I will incur high losses, and there will be absolutely no backup for me. So this becomes a key control. As again, something where I say that my petty cash expenses of 500 rupees was not approved for one instance. So if my the likelihood of something going wrong or the impact is lower, my control becomes a non-key control. Similarly, the nature of the control will also depend whether it is a preventive control or a detective control. Now, when we talk about a preventive control will mean something which will prevent from a for prevent an error from happening. So, say for example, if my system does not allow issuing a PO beyond the approved budget. So, if I'm crossing a budget and my system will restrict me to issue a PO beyond the approved budget, it's a preventive control because it will prevent me from making an error of shooting my budget on a higher note. At the same time, if I do a review of open POs on a monthly basis at the end of the month to see if there's something which is on a open for a longer period of time, that becomes my detective control. And fraud control. So whether a control as a fraud related control would essentially mean whether a failure of this particular control result into fraud with the organization. So such controls would make would be related to something like presence of multiple authorization at various stage of high value transactions or data ranging review. I'm shooting sales very high, but I'm faking sales, and then I'm making the datas converted into bad dates. So these are all form of frauds which can be identified through these kind of nature. Again, the understanding the nature of a control will help you understand whether the impact of failure of these controls is high or low, and will ultimately make an impact on your reporting whether effectiveness is adequate or no. So understanding the nature of the control becomes of prime importance here. Now, when we talk about internal control and environment, the entity we've spoken about this entity level control, IT controls, and process level control. So these are the major control environments that we've understood. Now, when we talk about entity level controls, like I said, my code of conduct that I take for all my employees, whether my job roles are defined and for all the employees, and my posh policy is in place, whistleblower policy is in place. All these are entity level controls, and these need to be uh, controlled at the management level and an organization, which makes it reliable for the process owners and the organization. So this usually will have board approvals, my policies in place, whether those are revised on timely manner, etc. Now, when we talk about IT controls in today's time of audit, we cannot avoid the IT environments because 90% of my accounting and approvals happen in a IT environment. Right. So whether my user access has been properly, are there any conflict of interest in user access provided, whether there are policy defined on who, how are the segregation of duties identified, whether my access reviews happen in time, change management. So if I am changing my role from a purchase department to accounts department, whether my IT enabled accesses are reviewed and changed in time, or there is a delay which might result into a conflict of interest. Password policies, of course, automated controls. Automated controls would mean again system negative testing. Where if I'm saying that my system is configured in a way that this control is enabled in the system, whether my system is allowing me to execute that particular entry. Now, when we talk about process level controls, like I said, the fixed assets, treasury, payroll, expenditure, revenue, all these are different type of major processes. Again, this is an illustrative list. So each process would have 15-20 controls in underlying it, whether my fixed assets are safe and secure, whether physical verification is done, etc., etc. This is again an illustrative example of process level control where we spoke about what could go wrong and what are the control activities to mitigate the risk. So advances to vendor not adjusted against the bills. So whether my advances are mapped against the PO so that whenever I review or process a particular invoice against a PO, the advances will automatically be knocked off. When we talk about execution methodology, it is broadly divided into four parts. One is planning and scoping, so identifying what is the other is design and implementation, operating effectiveness, and assessment and reporting. Now, when I talk about planning, it essentially speaks about identifying my major processes, understanding the business and the size of the organization. Design and implementation would identify understanding the controls and the risks underlying those controls, and whether all the processes have adequate controls, or if there are any gaps understood during the walkthroughs, that for example, balance confirmation needs to be taken on a half yearly, quarterly basis. If it is not happening, that will be a gap at process level. So process level gaps will be identified at the designing level, and operational effectiveness will be where a control is in place, but for some reason it is not effective and it has been missed by the person who is the owner of the process. And the last part to this will be assessment and reporting, which we've discussed in detail earlier. When an auditor forms an opinion on IFC, it could be under various categories. One is unmodified opinion, which concludes that the financial statements of a given entity are presented fairly and all material aspects are covered. Modified opinion, where we would say that it is there, but it is, it has some improvement areas. Qualified opinion would form where, there is a possibility where uh, there could be a major failure of a high risk, of a couple of high risk controls, and so on and so forth. So this is a broad detail of the testing plan, where we talk about identify the controls to be tested, whether procedure of the so the what is the plan of testing, how do you test a particular control, extent of testing, which will depend on my nature and key, whether it is a key control or no, and define the test description. So what was evidenced, the documentation part becomes very, very crucial in this particular this thing. Evaluation of deficiencies, so it could be a design deficiency, it could be a operating deficiency, it could be a significant deficiency, which would mean anti-fraud program and controls, or deficiency in non-routing material manual transactions, etc., and material weaknesses, where which essentially means that the framework is not adequate and not operating effectively. So again, this is entirely speaking about the consequence of ineffective IFC. So the signs that entity needs to revisit and look at their control framework and understand how to improve it, and track performances against their budgets, forecasts, schedules, etc. Uh, the assertions again explain the applicability of a particular control, where we talk about whether it is a disclosure, a disclosure and presentation control, or existence, occurrence, validity. So whether it has to happen or it is occurring on a multiple occasions, whether it depends on the rights and obligations of a particular uh, you know activity, or it is ensuring completeness of transaction. So if I cannot delete the sales bills, it will fall under completeness. So responsibility of the management, it has to maintain adequate framework in place, and it has to ensure that there is adequate reporting on it, selection and application of appropriate accounting policies, making judgments and estimates that are reasonable and prudent, and requires board. Again, Rule 858 of the company's accounts rules, 2014, requires board's report of every company to state the details in respect of adequacy of IFC with reference to the financial statements. So it is majorly a management responsibility.
Hello, Disha.
Yes, ma'am.
Yeah, please go ahead.
Yeah. So this is an overview of what the IFC framework talks about, and how adequately it is being assessed and commented upon. Now, the Companies Act has also defined prescribed penalty implications if a company fails to have adequate uh, uh, framework and processes underlying the framework. So I would like to conclude my session on this, and would like to understand if there is anybody who would like to understand anything.
Thank you, Disha ma'am. It was an insightful session. We have few questions from CA Muskan Somani. She is asking how to check as an auditor audit trail present or not.
So various systems have now even some basic accounting systems as Tally have also come up with the requirement which is in line with the statutory requirement. So you have to basically, there are 2-3 points here which needs to be ensured when we are talking about audit trail, that the edit logs should not be editable. So you have to really understand the system, whether the system has the configuration to enable deletion of the audit trail. Again, it will depend on the system that the organization is using, the accounting system, and understanding the accounting system on how to look into this. I hope I have been able to answer the question.
The next question is again from CA Muskan Somani. Can you explain the RCM metrics again?
Okay, so the RCM metrics technically speaks about a particular process. So if I pick up a fixed asset process, so there could be multiple sub processes under a fixed asset process. Now these processes will have underlying risks. Say for example, if I'm saying something as simple as physical verification that needs to be done, it is a part of my fixed asset process. So the risk under this is that I would not know if a couple of fixed assets are missing at a location unless and until I go and do a physical verification. So the risk here will be absence of adequate possibility of unability to identify missing fixed assets on a timely manner, and the control for that could be a physical verification on a periodic basis, which will help me identify it in a timely manner. So risk control matrix essentially speaks about the process, the risk underlying the process, and the controls which are designed to mitigate the risk for the particular processes.
Okay. And the next question is from Nalini Malik. Who all are covered under officers for penalty? Like who all are the officers considered?
So it will depend from organization to organization. And when I talk about IFC particularly, it is the management. So the directors who are responsible for the compliance with the Companies Act for that particular organization would be the officers who would fall under that category.
Okay. Now the question is from Ashwini Talre. As a manager, whether it is required to have an independent IFC department?
The act nowhere specifically says that it requires an independent IFC document or a department per se, but it is the management's responsibility to have that framework and testing remarks in place, which can be further, submitted to the auditors and the audit committee on an annual basis. So it is completely on the department whether they want to have an internal defined department doing this on a year, round the year basis, or having assistance from a consulting firm like a CA firm or somebody who can help them with the testing.
Okay, ma'am. The next question is from Deepika. She is asking whether IFC applicability for private limited companies, whether it is compulsory or any limit prescribed in law.
There is a limit prescribed for these companies. So the section clearly demarks the applicability for a private company.
No further questions. So I would take an opportunity to thank you on behalf of Women's and Young Members Excellence Committee for sharing your expertise and insights on IFC with us today. You have made the session flawless and comprehensive with the help of various examples. Your valuable contribution has enriched our knowledge, and we truly appreciate your time and dedication. Thank you so much, ma'am. Once again, I would thank you for an captivating presentation. Thank you.
Thank you so much, Jhakna. Thank you.
Yeah, thank you. And I would request CA Avni Kabra to introduce our next speaker. Over to you, Avni.
Thank you. So good afternoon, everyone. Before moving ahead, I would like to acknowledge the presence of our Central Council member, CA Preeti Savla ma'am, the chairperson of Women Members Excellence Committee. Thank you so much, Preeti ma'am, for being here and for giving me the opportunity to share the screen with you. Moving ahead, today we are privileged to have Ms. Meena S. Rao, a highly accomplished chartered accountant with over 17 years of experience in audit and assurance, as our esteemed speaker for this session on audit trail from practical perspective. Meena's extensive expertise in audit and assurance, particularly in the consumer business, automotive and technology industry, makes her uniquely qualified to shed light on the intricacies of audit trail management. Her leadership in overseeing large audit teams for multinational corporations, listed entities, and PCAOB clients underscores her deep understanding of audit processes and compliance requirements. One of Meena's notable contributions includes co-authoring the guidance note on IFCO FR issued by the ICAI, showcasing her thought leadership and expertise in regulatory standards. Her dual qualification as a chartered accountant from both the ICAI and ICAEW, coupled with an MBA, reflects her commitment to continuous learning and professional excellence. Given her current role as a partner in the audit practice of Deloitte, Meena brings a wealth of practical insights and real-world experiences to today's discussion. Her perspectives on audit trail management will provide us with invaluable insights into best practices, challenges, and opportunities in ensuring audit trail integrity and reliability. Please join me in welcoming Meena as she shares her expertise and practical perspectives on audit trail management.
Thank you, Avni ma'am. Am I audible?
Yeah.
And let me just put up my screen. Just confirm if the screen is visible. Screen is visible?
Yes, it is.
Thank you. Thank you. Good afternoon, viewers. Thank you so much for giving us this opportunity to present on the practical considerations and challenges relating to audit trail. As you all know, audit trail is a new hot and happening topic in the corporate world today. March 24 being the first reporting for audit trail, there are a lot of discussions around scoping of books of accounts, the procedures that needs to be performed by auditors, what are the management's roles and responsibilities, and how do we report this in the audit report. So today in this session, for the next hour or so, we will take you through some of the practical aspects and challenges. Of course, there have been many sessions on this topic in the past where we would have gone through what the actual rules and regulations are. So I will keep that to a minimum and go into practical considerations. Just before I do, there is an announcement from the WMEC. When you log into the portal for your live view of this session, there are two boxes below for self-assessment questions. Kindly go through those self-assessment questions and answer them as and when you have some time in between. The answers to those self-assessment questions will be provided towards the end of this session. So let's come back to this topic. So today's session, I will let's first understand a little bit on what this audit trail feature is and why did this come into picture. Currently, in the corporate world, there being a number of MNCs and organizations with books of accounts outside India, books of accounts maintained in cloud, even for companies in India. It's very difficult to track, a backup of a particular accounts, or to see what changes were done, who made those changes in the account balances. And therefore, one of the key things that the regulators came up was the audit trail requirement. It was possibly also the intent to make sure that or to prevent fabrication of books of accounts through overwriting of the books. This audit trail feature is easily expected to track what changes have been made and who made those changes. One of the important aspects to note that this is a first time reporting that is coming up.
So, Meena, I'm Preeti Savla and I'm sorry to disturb you at this juncture. You are supposed to start or might have started a few minutes ago, but I feel let me address for 2 minutes to my members and then you can start the session.
Sure.
Yeah. So thank you, first of all, Meena, for accepting our invitation and being presenting yourself, your views and your experience. And I also thank Disha for being there to take the first session. And I can see Disha, Urvi, and Avni, and all my dear Zankhana, all my dear moderators. So happy to see all of you here together on the screen on this webinar, Yashaswini. And friends, this webinar this year we have started and we have structured this session till June. And I'm happy that all are learning. This is a learning process shared by all extreme, well-equipped, knowledgeable speakers and very enthusiastic moderators. And my dear, very beautiful and intelligent women participants. This is an initiative which has been started 2 years back in the form of Sky High Symposium. We have completed 100 episodes, and this year we are coming out with this new shape, that is Yashaswini, a successful women an idol, that is inclusivity, diversity, outstanding performance, and the leaders. And this is all we represent the women fraternity, our CA women fraternity, and Yashaswini. And friends, last year, we have started, all of you are aware about our first time ever, the CA Women Excellence Awards. And this time we are coming out for the first time, International Women Conference. And this we are planning on 28th and 29th of June 2024 here in Mumbai. So mark your calendar, and immediately in a day or two, we will be releasing the registration also. And that the theme is Falcon. Falcon is a bird which is flying high and is the very, very swift, so very speedy, which the women represent, and with lot of abilities of leadership and high flying high. And that is what we represent with the Falcon, which will be having the global networking, which will provide the professional opportunities in different areas, the technology, We are tying up with the media also, and our media partner will be finalized soon, maybe Z Business. Again, prior to that, on 28th June, we will be having a networking event, and that is also at Mumbai, where we will be releasing our mobile app for flexi and part-time work with CA firms and the corporates. So, a lot of women are asking for the part-time flexi work, and that mobile app will be launched on 28th June, and that will be as easy as possible, where you can easily get the firm near your company, nearby your residence area, and you can choose and select your area and or area of your comfort and work as per your flexi or part-time work. So these are a lot of initiatives at Women Members Excellence Committee of ICAI we are bringing. So please stay connected and join for all our initiatives of Women Committee. Further, if you have any suggestions, please feel free to connect with us, because our entire committee, secretariat, Tapulapta, and our entire team is working very hard to reach out to all of you. It is our endeavor to serve all of you the best. With this, once again, I welcome all of you, and stay connected, stay in touch, and ensure that we cater the best thing. It is my endeavor to serve all of you the best as a women fraternity. And I request Meena to continue with the session, and thank to all my moderators and speakers for being here. Thank you very much.
Thank you, Preeti Salva ma'am. Let me present my screen back. Could anyone just confirm if the screen is visible?
Yes, Meena, the screen is visible, and audit trail is one of the very, very important topic in today's time, because this is a mandatory requirement by Ministry of Corporate Affairs, and that is why this session is very, very important, and your deliberations will be very important.
Thank you so much, ma'am. So before we get into the intricacies of what books of accounts need to be covered for audit trail and how to do these audit procedures, let's just spend a couple of minutes understanding the requirements. Section 128(1) of the Companies Act requires every company to maintain its books of accounts in electronic form. Further to that, the Companies Accounts Rules 2014, the Rule 31 requires that it should be accessible in India. If the books of accounts are maintained in electronic mode, it has to be accessible in India. With effect from 1st April 23, the new addition to this, which is the proviso that was introduced, is for companies to have accounting systems which have a feature of maintaining audit trail, and such audit trail being available, being able to capture the details of what changes have been made, who made the changes, and when the changes were made. And we'll go into specifics around that. Similarly, the auditors are also required to report on this. And where did this requirement come from? Section 143(3)(j) requires, of course, the internal controls reporting, which we heard a couple of minutes back. Section 143(3) requires auditors to report on various matters in their audit report. It also, subsection J says there are certain other matters that needs to be included in the audit report. And under the company's accounts and audit rules, Rule 11, a new rule was introduced with effect from 1st April 2022. You will see a mismatch in the date here for what the companies had versus what the auditors had. We'll come to that. The auditors are also required to report on whether the accounting system used by the company does have a feature of audit trail, and the audit trail was maintained throughout the year, and whether it was tampered or not. Now, of course, there was a year of mismatch between the date it became applicable for companies versus when it became applicable for the auditors. So for March 23, the requirement was to just report saying that this is not applicable for the companies, and therefore we have not reported. However, we don't need to dwell that much now, considering that this year is over. For 31st March 2024, this reporting will be mandatory for all companies. Now, let's understand which companies is this applicable. It's applicable for all private, public, and foreign companies. There is no threshold, unlike in any other requirements of CARO or internal controls. It is applicable for all of the private, public companies and foreign companies. Government companies, including state government companies, it is applicable. One-person company, Nidhi companies, Section 8 companies, it's applicable. It's also applicable for banks and NBFCs which are incorporated under the Companies Act. Now, whom is it not applicable? Of course, individuals, partnerships, HUF, AOP, BOI are not registered under Companies Act. This requirement comes from Companies Act and therefore it is not applicable for them. It is also not applicable for partnership firms and LLPs, cooperative societies, and any companies incorporated outside India. If a company is incorporated outside India, say in Singapore, US, or any other entity, though it is a subsidiary or an associate of an Indian entity, it will not be applicable for such subsidiary or associate if it is incorporated outside India. It is also not applicable for trusts. Now let's just deep dive a little bit on what the requirements are. Or what the similarities are between the requirements for a company, which you see in the fourth column here, applicability to companies accounts rule, and applicability to companies audit and auditors rules. So both of them require whether the company, it is applicable to every company covered under the Companies Act. The accounting software should be, which is used for maintaining of books of accounts. It is applicable where there are accounting software used, which means that if a company is doing a manual books of accounts, they are literally maintaining in hard copies of registers, this rule does not apply. The accounting software, such accounting software should have a feature of recording audit trail. And it should be available for each and every transaction or all transactions. So this is something common for both the companies and the auditors. Now, there is a slight difference between what is required for companies and what is required for auditors as well. For the companies, the requirement says such feature should also provide for creating an edit log of each change made of the books of accounts along with the date when the change was made. This is not specified for the auditors reporting. It also requires companies to ensure that the audit trail is not disabled. So at any point in time, the audit trail should not be disabled. While a specific requirement is not there for the auditor to report on such, auditors are required to report whether it has not been tampered with, right? Tampering is something that is intentional, right? Whereas what the companies have to report is whether it has not been disabled. So there is a slight difference if you see point number 2 and point number 4. The audit trail feature has to be operated throughout the year. That needs to be reported by the auditor specifically in his comment. So when the auditor reports in Rule 11G in the audit report, he will have to say whether the audit trail feature was operating throughout the year. There is also a requirement to preserve the audit trail as per the statutory requirements of record retention, which is 8 years. That also the auditor has to comment in his audit report. While it is not specified in this particular proviso for companies' accounts rules, however, the books of accounts does include audit trail. So even the companies are required to comply with this requirement, though it is not specifically mentioned. Let's now understand what are the books of accounts. So just before I go to this example, which is also available in the implementation guidance, and just to highlight, there was a revised implementation guidance issued by the institute towards mid of February 2024, which captures number of FAQs and the requirements of what the management and the auditor has to do, and it's good that all of you take a glance through that. It's very detailed and comprehensive. The definition of books of accounts under Companies Act, if you see, covers any transaction. Sorry, I would like to go back a little bit. The books of accounts as per section 213 of the Act, it says that records maintained in respect of any sums of money received and expended by the company and matters in relation to receipts and expenditure, which means that it will cover all my expenses and income, all sales and purchases of goods and services by the company, P&L. So the first two covers the entire P&L, the assets and liabilities of the company, and any items of cost that may be prescribed by section 148 of the company which belongs. Further, this requirement also says that you need to cover this for vendor, for the master data. So is it applicable only for a ERP? The answer would be no. It is also applicable for other applications to the extent that it involves any data pertaining to books of accounts. Either it contains, either it is starting or it is the base for the information to be created. It is a system where the data is held, or it is a reporting system. So either of those three cases, you will need to include the applications. Now, the definition of IT applications or the application systems also includes data base, data warehouse, data lakes, interfaces, and also the application system. So even the database supporting any application will have to be covered for audit trail. Changes made directly into the database also have to be enabled and logged. Now let's take an example. SAP S/4HANA. Let's assume that this is a core ERP. All account balances are maintained here. The journal entries are posted in this system, which means that, of course, the books of accounts are maintained in the system. So this also has the general ledger. It also has the sub-ledger maintained. It is also the destination system, which means destination system, it is the system from which my final trial balance is also getting generated. So SAP S/4HANA in this case ticks off everything. So audit trail has to be maintained for this. Now let's take an example of Wrapper. Wrapper is similar to Workday or the Great HR, a number of HR payroll application tools that we have. Now this system may or may not be interfaced with SAP S/4HANA for the final accounting. However, it does contain financial information. It does contain the employee master. The employee salary processing happens through this system. So it will have to be included for audit trail. So as long as it even contains the master data, it will get covered for audit trail. Now, let's take another example where it is only the employee master. It does not have the processing capabilities. It's only capturing the employee master. Any changes to employee salary, any changes to employees' bank account details, etc., is done in this pay software. No accounting entries are posted through this system. Neither does it perform any processing. Even then, this system will have to be covered for audit trail. Master data have to be covered. It is very specifically mentioned in the implementation guidance as well. Let's take another example. ServiceNow, IT ticketing tool. Most of the companies would have a portal where you actually go and say, okay, give me access to this particular Zoom link. Or I don't have access to create emails, or my email is not working, or printer is not working. So we go and raise tickets, right? And those tickets go to the queue to the IT person and they resolve those. That is also an application system. That is also a IT application system. However, it does not have any financial information, no books of accounts. It's for a pure day-to-day operations of the company. That's got nothing to do with audit trail, right? So primarily, all accounting applications which have any data relating to books of accounts, which is cost, asset, liability, P&L, receipts and payments will get covered. And if it also has master data, it will get covered. Now let's look at some intricacies or some special considerations that have come in. The first one, we did see books of accounts. Now, what is books and papers, right? Books and papers. Papers is defined as something which is the evidences of document, like say rental agreements, a purchase order document, or let's say a manual voucher that is available, cash voucher that is available. So does audit trail requirement apply to these? The answer is no, because the rule requires only for books of accounts, not for books and paper. And why I'm repeatedly looking at this is because of the other requirement which was there on the backup. The backup requirement, which was amended on 5th August 2022, covering that the backups of books of accounts and books and papers have to be maintained in a server physically located in India on a daily basis. That requires even books and papers which are in electronic mode. However, audit trail does not require papers to be maintained. So if, let's say, the company has all the rental agreements that they have uploaded on a software, and all the rental agreements are available in a system, there is no trail required to be maintained for compliance of this section. However, if someone has access to amend the agreement or change the agreements, that's an internal control aspect. That is no relevance for the audit trail requirement. There is no requirement to maintain audit trail for papers. Now, subsystems. What are subsystems? Subsystems could be any type of auxiliary system which feed in data to the main accounting application. So let's take an example of a large retail company. You would have all gone to say Reliance supermarket, or you would have gone to DMart, right? Those are the common locations that we see outside. They will have a system in the location for billing. Sales are getting recorded in those billing systems. Those are called POS, or point of sale systems. Sales is initially recorded in that system, and from there the transactions are either on a daily basis or on a real-time basis, or sometimes with a 15 minutes gap, gets uploaded into the main accounting software, either through an interface or through a download and an upload format. Either way, the information from the ancillary system moves to the main accounting application. So even those ancillary systems have to be covered for audit trail. It is not just the main accounting application, because sales is covered under the books of accounts definition. We just spoke on what software is. Software includes applications, web portals, database, data warehouse. So if there are certain interfaces, so for example, HR data is maintained in Great HR, and from there is an interface to move it to SAP. Now, if the interface also stores the data for a certain period of time, or if there is access to that interface, the audit trail has to be enabled, because someone can go into the interface and make the changes before it comes to SAP. The most common issue that we see is a lot of applications are maintained in Excel spreadsheets, right? FAR, the most common one, expected credit loss working, impairment working. A lot of things are done in Excel software, and then the final entry is posted into SAP, or say Tally or Oracle, whichever is the application system. Some cases we also maintain master data in Excel application. So does Excel require to be covered? This question was specifically answered in the revised implementation guidance that came up in question FAQ 25, which says that if the spreadsheet is also an accounting software, and if it provides direct and auto feed to the accounting software, then you need to capture it. Now, if you ask me practically, direct and auto feed to the accounting software, is it possible? Very, very unlikely. So you need to evaluate. Most of the situations that we have seen, it may not be possible to have a direct and auto feed to the accounting system from a spreadsheet. Therefore, this may get excluded. So if the company is maintaining PPE or any other aspects of the financial statements in Excel, unless there is a direct and auto feed software feature to the ERP, this will not get scoped in. Access management tool. What is an access management tool? It's an application where you can give access to a user to a particular application. So let's say the company has SAP. New employee joins the company. The new employee has to be given access to SAP. He may be given access to all modules, or he will be given access to only, say, vendor management module, or say receivables module. He will not be given access to all modules. So there will be a tool called access management tool, and I can quote some examples. For example, Jira is one of the access management tools. SAP itself has a GRC, which is a access management tool. These tools will provide access to the main SAP application. This tool, by giving access to SAP, is not creating any new accounting entry, or is not creating any impact on the books of accounts. It's only giving access to a particular user. Therefore, access management tools by itself need not be covered, or are not required to have audit trail for the purpose of the audit trail reporting. However, access management tools are covered under the general IT controls testing, which we need to do for an internal controls reporting, because the controls over who is given access to do what is an important aspect of the internal controls reporting. Therefore, while this may be covered for general IT controls testing, it will not be included for the audit. It is not required to include this for the audit trail testing. Now, what's a SaaS software? SaaS software is a system or a software where a company is provided a license to use that software for a certain period of time, and it is normally hosted on cloud. So irrespective of where the software is, where the accounting software is it SaaS based software, is it outside India, it is within India, it is on cloud, it is hosted locally, none of those matter. All of the cases, audit trail will have to be maintained irrespective of where the software is hosted or how it is hosted. Servers located abroad. Yeah, most of the MNCs today have Oracle or SAP situated somewhere outside India. Does not matter. Audit trail reporting will have to be carried out for those also. The next typical example that we see is consolidation software. A lot of companies use Blackline or say something like Hyperion for passing consolidation entries. They may also be using Excel sheets for passing consolidation entries. Now, is consolidation software covered? Yes, consolidation software console entries are also part of books of accounts. Therefore, this software will have to be covered for books of accounts. However, if it is in Excel, the same question comes back, whether it is providing an auto feed into the main application system. If not, it will not get covered. Now, let's take some more applications. A company uses, say, Blackline. Blackline is a tool where multiple use cases are there. Blackline is used for doing consolidation. Blackline in many companies are used for posting journal entries. They create journal entries in Blackline. They post journal entries in Blackline. It gets approved in Blackline. And then from Blackline, it is then interfaced into SAP, or it is interfaced into Oracle or NetSuite or various other applications. Now, I'm taking the last two topics together. Let's say it is used for creating a journal entry or reversing a journal entry or altering a journal entry. Then such software will have to be covered for audit trail because journal entry is part of books of accounts. However, if it is used only for performance of a control, say for example, in many companies, what they do, they use Blackline for performing intercompany reconciliations. Right, intercompany reconciliation or any sort of a balance sheet account reconciliation after the books of accounts are prepared. So after the journal entries are posted, after there being already a books of accounts, records and transactions, they take the information from the record. So for example, they take the vendor balance from the main application system through an interface, possibly through an interface or manually into Blackline, and they perform a reconciliation of the GL through Blackline. Doing that reconciliation is a performance of a control after books of accounts have come in. It is not resulting in any new transaction or new record. Therefore, it need not be scoped in for audit trail. If let's say the application is used to create a journal entry or to create a record or to create any sort of a entry or a change in the application system. And when I say record and transaction, it is not just journal entries. It is any type of a change in the system which is impacting the books of accounts. For example, in SAP, we have tables, right? The tables capture details of, say, GST rate or TDS rate. Now, if someone goes and changes TDS rate or GST rate, that also impacts in a change in my books of accounts. So those also will get captured for audit trail. Those also needs to be covered for audit trail. So it is not just the journal entries or the entries posted in the books of accounts. It also covers all of the backend transactions. Now, what audit approaches are required? Primary responsibility is of the management to maintain audit trail. Of course, if the management has not done anything, of course, auditors cannot test something which doesn't exist. So the management has to first provide the details of the books of accounts. They have to first identify which are the books of accounts that is available. Now, one key thing to note here is there is no concept of materiality in audit trail. Right? I cannot say that this particular application does only one small portion of my books of accounts. It's very immaterial, so I will scope this out. No, that is not possible for audit trail. Every accounting application, if it fits the requirements, it will be scoped in irrespective of the volume or value of transactions that is processed. So it's the responsibility of the company to identify which applications are required to have audit trail, and in that application what transactions or records are required to maintain, are scoped in or are covered for audit trail. So when I say what transactions and records, like the same example I took, if let's say the company has black line doing both posting of journal entries as well as doing a post balance sheet reconciliation, it may be required only to scope in for the journal entries, not for the balance sheet account reco, which is performed after books of accounts are created. So the company has to identify this and provide. Now, there could be a situation that the company has an accounting application which does not have a feature of audit trail, and only one person has access, right? So looking at the system date, everyone can figure out when the entry was posted. Knowing that only one person has access, we can also say who posted the entry or who made the transaction. And anyway, the transaction is available, so you can say what transaction. Does that mean it is in compliance with the requirement? No. The requirement starts with the wording saying such software should have a feature of audit trail. So irrespective of how many people have access to the software, one person, two people, or that a particular entry posted or a transaction posted can never be changed in that system, does not matter. The software still needs to have a system of should have a audit trail feature, and this is very clearly clarified in the FAQ. The audit trail has to also capture changes for each and every transaction in the books of accounts. And what does the audit trail change? What should the audit trail capture? It should capture who did the change, who did the change, when was the change done, which means the timestamp, and what was the change done. What was the change done could be things like PO created, PO edited, number of quantity changed, or say value changed, and whether it was a success or a failure. Right? The company should also make sure that the audit trail feature is always enabled. It should not be disabled, and it should be done at a database layer, which is very important. A lot of times when we look at the applications, SAP, yes, SAP at a top end level, the configuration is enabled and therefore it is complete. No, we need to go back and look whether it is also done at the database level. The company should also ensure audit trail is protected from any modification, and they have to retain it as per statutory requirements, which is the 8 years record retention requirement. They should have control to make sure that this maintenance and monitoring of audit trail feature is there, and it is designed and operating effectively. So there are certain controls that the implementation guidance has given as an example, which will enable the company to evaluate all of these aspects. Now, when I say it's also the management's responsibility, the board of directors have to also take this on record when they are approving the financial statements to make sure that what are the policies and procedures that the company has for ensuring compliance with this requirement, and whether the controls on this audit trail is operating effectively or not. Now, there, of course, specific controls we will look into. There might be certain controls relating to audit trail which will overlap with the general IT controls. General IT controls are mainly in relation to logic security, database, and access controls, right? The access controls related controls will slightly overlap with the audit trail controls. But however, the company has to have this audit controls for audit trail, include them in the RACM or the risk control matrix, and test them year on year. Moving on to what we should ask the client, right? Let's say a company is has implemented all of this or has not implemented all of this. Ideally, in this order, we need to get this set of information. What are the in-scope applications and what are the scoped out applications, along with why is it scoped out? Ideally, we should not have scenarios of scoped out applications if it does not, not because of materiality, right? They should not be scoping out because it is immaterial. It could be scoped out because it does not have any books of accounts related information. What are the key transactions within each of these applications where audit trail is enabled? Then the confirmation, of course, from the management that it is enabled from 1st April 23 and it is not disabled throughout the year. This is more of a representation, however, does not absolve us from performing our own procedures as auditors. Who are the users in each of these applications who have access to maintain the audit trail configurations? Who has the access to edit? Is there an access given to edit audit trails that are extracted? How is it stored? The access to the audit trail itself should be restricted. And what are the management controls that they have to ensure that any access provided to the configuration or the table have been reviewed, that whoever has access have not done anything which is not required to be done, which means that they will need to look at the controls around the edit log and the changes that have been made. There are also certain controls that the company has to maintain. First control is to make sure that it is not disabled or deactivated, which means that someone reviews it periodically, or no one has access to, in fact, disable or deactivate. This is something very simple in the latest version of Tally, for example. By default, the Tally new edit log application does not allow you to disable it at all. So the company may or may not have this control. It is by default there. Whereas other applications, there is a chance that the company can disable it or deactivate it, or pause it for a certain point in time and reactivate it. So how is the company ensuring that these changes are not made? Who are the users assigned to each individual? Now let's say there are generic user IDs, which means that it is difficult to identify who actually posted the IDs. So ideally, the company should not be using generic user ID for posting entries or for making any changes. Changes to the configurations of the audit trail. So every table or every custom T code in SAP or Oracle will need configurations to enable audit trail. So that has to be through authorized people, and there should be a log maintained as to who is doing those changes. Otherwise, it is not possible to identify whether there was sufficient control over these audit trails. Who has access to the audit trail that is generated, whether that is restricted, whether audit trails are maintained for the required number of years, and there are no changes made to the audit trail. If there are changes made, then effectively the whole purpose of this requirement is failed. Periodic backups should be taken, and how is the company ensuring that periodic backups are taken and the old ones are retained for a period of 8 years? Of course, this requirement will be applicable after this year's completion. The implementation guidance has specifically mentioned that auditors have to report on periodic backups from next year, which is March 25. Moving on, what is the auditor's responsibility? As an auditor, we need to verify whether, firstly, can the audit trail feature be configured, right? In some applications, it is by default on, so nothing the company can do. So it is very good and easy. Whereas in most of the applications, it is for the company to go ahead and enable it or disable it or make changes. So we need to see whether it has been configured and can it be disabled once configured, can it be tampered, can it be changed? Whether all transactions are recorded in the audit trail feature. And how will I test this? We cannot do 100% testing. So the implementation guidance thankfully provides us an option of doing the test check feature. So you can pick up certain transactions and see whether those are covered in the audit trail report that is available. Did it operate throughout the year? This is something tricky because most of the companies started implementing this after they became aware of this. So it may or may not be implemented throughout the current year. So this will have to be specifically reported. Also, at this point in time, in some of the applications, if I go and say whether it was enabled or operated, we cannot go back and see from which date it is enabled or operated unless an edit log of the changes is maintained. Right? So let's say when I make a change in the system. So today I go to SAP and I switch on the option of maintaining audit trail. Right? Unless I have a log of any change that I make in the audit in the application, no one will know when the change happened. So the companies first should have that log enabled to say that these are the changes that are happening in the configurations. Then you can know that, okay, audit trail configuration started from say 1st January 24 or whatever date the company maintained. So this is something tricky and is required for us to know when we go back and test the applications. We should also go back and check whether audit trail has been maintained as per the statutory requirement for 8 years. Moving on, I'll just skip this. This is a little bit of a one of the key things that we'll also have to see is who has access to such configurations. Were there any changes made to the configurations during the period in time that can be viewed from the system configuration options? The completeness and accuracy of the audit trail. The audit trail is also an information produced by company IP, which needs to be tested for completeness. So how is the management ensuring that it is complete? It is covering all the transactions. We can go back and check the number of transactions versus this report, or you may go back to a particular date and check whether all the transactions of that date are getting captured. And whether it is capturing who made the change, the time of the change, and what fields were changed. This can be done on a test check basis. Of course, we also have to ask how management has ensured that audit trail is getting captured for full period. These are certain technical aspects, so it may be important to take the help of a IT specialist also to perform these procedures for application by application basis. Okay, the other key thing is many of the applications are maintained by external service providers. Say for example, Workday is maintained by a service organization. There could be many other payroll softwares which are maintained and monitored by various service organizations. In which case, we normally get something like a SOC 1, SOC 2, SOC 2 report or a SAE 3402 report from the auditors of those service organizations, where they provide assurance on the controls of that entity. So we need to go back and inform the management to inform the service organizations in turn to get the audit trail requirement also covered in these reports. If the service organization report does not cover reporting on audit trail, we will have to specifically mention that in our reporting. Moving on. So what do I need to document? If I have not documented, then as an auditor, I don't know what I have tested, right? So we need to cover in our documentation sufficient detail to say how did I conclude whether the audit trail was available or not. There is no specific template or format that is provided. It is at the judgment of the auditor to document this, but it will have to cover all of the aspects relating to controls, the testing of the audit trail that is available, the samples that were performed, sample testing that was performed to see the aspects covered, and how did we ensure that it was maintained for the full year or part of the year, and that it was not tampered. These aspects will have to be covered in the documentation to provide a basis for our audit report. Some specific matters that I'll cover before we go into the reporting aspect. We spoke about materiality. No materiality concept in this whole audit trail. We will need to audit trail has to be enabled for each and every transaction. The application scoped in will be for all the applications having books of accounts data. No concept of materiality with respect to that. However, for our sampling, we can use materiality. Service organizations we spoke, it does not matter whether the software is based in the company's server or it is by a third party. Audit trail will have to be covered by the service organization's auditor. Application versus database layer. Some of the applications have their own inbuilt database, like SAP will have its own inbuilt database. However, not all applications will have the database linked to the same application. So either way, both of them will have to be covered for audit trail. So changes that are directly made at the database also will have to be logged and tracked. So there are some situations what the way the systems are configured is that the ERP is maintaining only the latest changes, right? So let's say today I have a journal entry posted. The journal entry got edited once. The journal entry also got edited second time. The same entry. The user went and changed the journal entry. First he changed, say, the credit account. Nextly he went and changed the amount. If the audit trail is maintaining only the last change and not both the changes, then that is not in compliance with the audit trail requirements. It should record each and every change. if only the amount, the last change that was made is retained, that will not be sufficient. Now, there are certain softwares, we spoke about this, accounting software, which does not allow modification, right? Does not matter. Still, the software should have a feature of audit trail. Audit trail, is it required to be maintained when there are no transactions at all? Let's say the company does not have any transactions at all. Doesn't matter. The auditor will still need to be, the system still needs to have a feature of audit trail, and the auditor can mention specifically, modify the report to say that this, while there were no transactions, this was not enabled, or the system did not have the audit trail feature. Branch. So let's say there is a branch within India or outside India. Branch is a part of the same company, incorporated under the Companies Act. So it will have to be covered for audit trail. Joint operations, yes, needs to be covered. These are part of the same standalone financial statements. Now, there could be some situations that there is a technical glitch, there is a power drainage issue, or there is a damage to the servers, and therefore audit trail could not be maintained or was not captured for, say, a couple of minutes in a full year. The auditor will need to modify his reporting, because the requirement says that it has to be, the auditor has to mention that it has not been tampered throughout the year and maintained for, the audit trail is maintained for each and every transactions throughout the year. So even if it is not maintained for a very short period of time, the auditor will need to bring in the fact in the reporting. It is a fact-based reporting and not an assurance-based reporting. What is the difference between an error log and an audit trail? Some systems, some companies come back and say that we have an error log. It gives me a list of errors that have been captured. No, error log is different from an audit trail. Error log is something that records any processing errors that happens, right? Let's say someone tried to create a journal entry. The entry did not get posted. Due to some system issue, it will create an error log. Someone tried to change the GST rate. It did not capture, or the GST rate did not get updated for all transactions. That's an error log. Whereas audit trail is a sequential log of all changes made to the books of accounts, which means including transactions and records, capturing who made the change, what was the change done, and when was the change done. This audit trail is not an alternative of error log. Error log will only capture errors. Audit trail has to capture every change, whether it was success or unsuccessful. Is backup an alternative of audit trail? No, backup is just taking the entire books of accounts, taking a photocopy of it and keeping it aside. Backup is required to be taken now on a daily basis, right? And normally in a case of a backup, the way it is done is, considering the voluminous data involved, the backup will replace the earlier backups maintained. So whatever final backup today some company should have for the last 8 years. Backup is also required for the retention period. But you may not have it on a daily, you may not have all the backups of a daily basis if you're doing a full backup mechanism. If you're doing an incremental backup mechanism, that means today I entered 10 transaction, backup of 10 is taken. Tomorrow I entered 10 transaction, backup of 10 is taken. Instead of taking the backup of all the 20 transactions at a whole. So depending on the type of backup used, the company may or may not retain the old backups. It will normally get overwritten. However, audit trail will have to be maintained for all of the transactions. Audit trail is not a backup. Audit trail is telling what changed when. Backup will not change. Backup by itself will not tell you what changed when. To find out what changed when, you will have to go compare yesterday's backup versus today's backup, or in time backup. Last backup taken at 10 o'clock in the morning versus 10:01 in the morning. Compare it by yourself to see what change happened. So it's completely different aspects. Backup is not equivalent to audit trail. So most of the companies having backup come back and say we have backup that is sufficient, that has all the data, who posted the entry and all. No, it cannot be considered as maintaining audit trails. Some aspects in relation to general IT controls, right? Let's say the general IT controls of a company failed. The general IT controls could have failed for various reasons. It could have failed because there was access control issue. It could have failed because there was password configuration issue. It could have failed because some aspects of the logic security have been exploited. Changes have been made to the servers without adequate authorization. Various aspects could be involved for failure of general IT controls. That does not mean that audit trail is also failed. Both have to be tested independently. Some aspects of failure of general IT controls will have an impact on audit trail feature. For example, if access control failed, that the people who have access authority to make changes or the logs of changes, SMP logs, etc., are not maintained in SAP, that could have an impact on audit trail. But not all failure of general IT controls will have an impact on audit trail. Both will have to be independently tested. There could be a risk with general IT controls failure. However, there is a possibility that audit trail feature is adequately maintained. So the auditor will have to test this in detail before looking at if there is any modification required. Now let's take another example. Impact of modification on audit trail reporting on internal control. So let's say audit trail is not maintained. Does that mean that I need to modify the internal financial control reporting? The answer, a straight answer would be no. It depends on what the impact of audit trail is. So for example, the company may have a audit trail, the company may not have an audit trail for say changes made to purchase order, right? However, every purchase order may be manually approved by the management, manually approved by the CFO before it is sent. While system related control is not there, system related audit trail is not there, there is probably another manual control which is mitigating the risk arising out of this, and therefore it may not have an impact on internal financial control. There are innumerable examples of that. Just because an audit trail feature is required may or may not mean that internal IFC reporting fails. So this will have to be very clearly looked at case by case situation to see whether audit trail failure leads to internal controls reporting failure or not. Now, there is also a requirement. We spoke about controls on audit trail some time back. Management should have controls on audit trail. Is it operating effectively, etc. Now, internal financial controls reporting does not require us to report on the operating effectiveness of audit trail. However, if audit trail is not maintained, it may lead to the impact on maintenance of books of accounts from a internal financial controls reporting perspective, because audit trail is considered to be part of books of accounts. So to repeat again, failure of general IT controls does not always mean that the audit trail is not enabled or does not work. It will have to be independently verified. Some could have an impact. Some aspects may not have an impact on audit trail feature. Audit trail failure does not always means that internal IFC report is modified. It will have to be again evaluated independently and case-to-case basis to see if there are any other alternate controls which will address the issue. Operating effectiveness on reporting of audit trail is not required to be covered in the IFC reporting area. Now we have, I think, about 10 minutes, so I'll quickly go through the some specifics and some examples. I think Tally is one of the most commonly used application. So Tally ERP 9 and previous features are not having the audit trail features. They do not meet the MCA requirement. Tally Prime 2.1 has audit trail feature which is enabled. So as an auditor, we need to ensure that it is not disabled throughout the year, because it can be enabled and disabled both by the company. Then a backup of that will have to be taken throughout the financial year. So Tally Prime 2.1 does meet the requirement of audit trail, and there are certain procedures that the auditor will have to do here. However, the Tally Prime 2.1 with edit log, there the company cannot change it at all. So once the feature is enabled by the supplier, it cannot be disabled at all. It's by default available. Therefore, there is no disablement of audit trail feature that the auditor will have to look at. So of course, the last one is the most latest version, and it meets the requirements of audit trail feature. So we spoke about preservation of audit trail for a period of 8 years. Of course, for March 24, this reporting in relation to preservation of audit trail for the next 8 years is not required. This is clarified in the footnote to the implementation guidance. This will be required from the upcoming year. Now, reporting. So, is this required in case of consolidated financial statements? Yes. In case of consolidated financial statements, if there are component auditors who are auditing the subsidiaries or associates or joint ventures, their report should be used as a basis for the parent auditor to report. So, if the subsidiary auditors have reported that there are some applications which don't have feature of audit trail, that will have to be replicated in the parent company auditor's report, irrespective of materiality of those subsidiaries, associates, or joint ventures. The impact of not having audit trail, the auditor will have to evaluate whether there is any impact in relation to compliance with laws and regulations, and if any reporting is required in that aspect. I think we spoke about this. If the books of accounts are maintained manually, this rule 11G will not apply. Now, here are some examples of the reporting, but I'll kind of move through this very quickly. These examples are available in the implementation guidance. There are also various other reporting scenarios that are available in the implementation guidance like this. Say it was disabled for one of the books of accounts, or it was not operating effectively throughout the period, or the third party auditor did not give the report. And mind that in many companies, it may be a multiple scenario combination, right? I may have one software which is maintained by a third party. There could be one software where it was disabled, one software where it was enabled, it was not operating effectively, right? There could be multiple combination of these reporting requirements. This fourth point in relation to audit trail has not been preserved by the company will come in only from next year, which is March 25, not for the current year. Yeah, this is an example we put up for where there are multiple combinations of reporting, where you would say that, say particular applications did not have audit trail for one of the divisions, whereas the other divisions it did comply, or particular application system did not operate effectively throughout the year, etc. So depending on the scenario, you can use a combination of these to have the report. Of course, consideration of fraud is one of the key aspects. By not maintaining audit trail, is there a leniency towards fraudulent transactions being conducted is one of the important aspects that the auditor should keep in mind while performing audit procedures. So what are the implications of non-compliance? Of course, this is an indicative non-compliance. This is not the only non-compliance impact. For the management, this will fall under section 128, for complying with the provisions of section 128. The penalty will be a minimum of 50,000 and a maximum of 5 lakh. Penalty under section 477 of Companies Act, which is in case of management was not maintaining edit log, and a fraudulent transaction happened, or to avoid certain things, the penalty could go up to a significant amount as per the chart to the right. Like I said, this is only an indicative non-compliance impact. This is not the only non-compliant. Now, if the auditor is not able to carry out the audit of this log, and if it ends up in a situation that auditor has also colluded with the management, then it can also lead to penalties under the same section, and as well as professional misconduct. I will end here and open up for any questions that you may have, and we can also go through the questions on the poll system, or the one that has been uploaded on your applications.
Hello, ma'am.
Yes,
Hello?
yes.
Am I audible?
Yes, please. You're audible.
So, ma'am, you have a few questions to answer. Okay. So, first one is how to check as an auditor, audit trail is present or not?
Yeah, so depending on the application, you will have to look at. So, for example, if the company has this tally release 2.1, right, then it is straightforward. You can ask the company to generate the logs, or show where they have retained the logs and how the logs have been maintained and preserved. Now, let's say it is SAP or Oracle, it is a bit more complicated. It is not just one application or one system. There are various configurations which will definitely involve use of an IT specialist to go back and check this. There are various SMP logs, ST logs, and so on, which needs to be evaluated. So it is not one single answer. SAP and Oracle have already published on their websites as to what configurations have to be enabled to maintain audit log. So you can look at that. Oracle has also published a paper which is available saying that these are the 3 or 4 options, or these are the 3-4 configurations that have to be changed by the company for audit trail to be maintained. So that is available on both SAP and Oracle's website, which the practitioners can look at. There are other applications like NetSuite, Ramco, where it is still difficult. Companies are trying to figure out how these are maintained or not maintained. So there is no one answer for those at this point in time.
The next question is, if an entity maintains books in Excel, then is audit trail applicable?
No, because it is not an, there is no accounting application software there. So there is no way the company will be able to demonstrate audit trail.
And this audit trail review is more of IT audit review, and a normal auditor may not be able to check in depth the assurances made by the management.
Yes, so this is kind of a combination of both the IT auditor and a normal auditor, right? So IT auditor will not be able to tell what all books of accounts have to be scooped in. That is the responsibility of the main auditor to say, okay, my payroll is sitting in this application, or in say Tally, these are the areas that needs to be looked at. The vendor master here is here. So a portion of it, in terms of the scoping of the books of accounts, the transactions, what has to be covered in audit trail is to be told by the key auditor. Without that, the IT auditor will not be able to test the specific applications. Of course, you need to take the support of the IT auditor to test in the system how these are maintained.
I think now there are no more questions, so we can end the session. Yeah.
Thank you so much.
Okay.
So, Saurabh, would we be taking up the questions on the portal?
I think he is not audio. He has no mic. He has turned off his mic. Wait.
Yes. Yeah, so there are certain questions posted as a self-study questions on the site. We will try and request that the answers be shared in some form for those questions as well. Thank you all for listening to this session. And if you have any questions, you can send it to the council and we will try and address that. Thank you so much. Disha, anything from you?
Yeah. Good evening, everyone. I feel incredibly honored and privileged to have been allowed to extend this vote of thanks. On behalf of the Women Members Excellence Committee, I would like to express a heartfelt gratitude to our esteemed guest, CA Meena Rao, who has enlightened us with her vast knowledge on audit trail. I can say this with immense confidence that today's session has provided all the participants with innumerable valuable insights and has undoubtedly helped us to achieve a clear understanding of the various issues that we as a community may face in our practice, especially now as we approach this upcoming audit season. I also want this opportunity to express a sincere gratitude to CA Preeti Savla ma'am for motivating and empowering all the women members by introducing Yashaswini and Idol webinar series. It truly gives all women members a platform to come together and learn. Also, a wide round of applause and thanks to the entire team of WMEC who has worked hard to ensure seamless coordination and management to make today's event a success. Lastly, I would like to thank all the participants for making the time to attend this event and making this a grand success. Thank you, everyone. Oh, yes, you can.